All right, since Atlassian stock is trading near its 52-week low, a lot of investors are interested in this company. They're interested in both buying the stock and selling the stock. Some of you that don't already own Atlassian stock might be circling and looking to add near 52-week lows. Others that may have already owned the company for a while are now considering to cut their ties and trying to decide if they should sell this company. Whether you're looking to buy or sell Atlassian stock, I'm going to share with you some details you need to know about the company before you make your investment decision.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now.
So the management team said about their guidance approach for fiscal year 2026 in that it's being consistent with the approach they took in 2025, which is we are taking what they believe to be a conservative and risk-adjusted approach to account for macroeconomic uncertainty and potential business disruption. So, as I've talked about in other videos, I don't like when management teams take a conservative approach to their guidance. I also don't like when management teams take an optimistic approach to their guidance. I prefer management teams just try to accurately predict what their revenue and profit and key performance metrics will look like in the upcoming year and the upcoming quarter. Let me make the adjustments to your forecast after I incorporate that into my macroeconomic picture and my geopolitical picture. If every company is making adjustments based on the macroeconomic environment, then as an analyst, I need to go in and determine how big of an adjustment are they making and do I need to make an adjustment on their adjustment, right? So it makes it more difficult for me to evaluate companies when management teams are conservative, like is the case here with Atlassian. And then you have management teams that are way, way too optimistic, like Tesla, and they predict things like our revenue is going to be $10 trillion by, 2035 because of robots, right? So they take a way too optimistic approach, and some companies take a way too pessimistic approach. And either way, I need to make adjustments as an analyst to make accurate investing decisions. And so I prefer companies just provide me with accurate information. So the company did say that they will be able to deliver 20% compounded annual growth from fiscal year 2024 through fiscal year 2027. And they believe with 20% growth in 2025, they've laid a strong foundation for achieving that and are on track to hit that goal. So that's an attractive revenue growth target on the top line for a company that in fiscal year 2025, they generated $1.4 billion in free cash flow on $4.2 billion in revenue. That's good for a 33% free cash flow yield. So when you have a company with that kind of attractive free cash flow yield that's also growing revenue at 20%, that could not only improve that free cash flow yield, but even if the free cash flow yield remains constant, that adds a significant amount of free cash flow because of the top line revenue growth. So that looks really attractive for Atlassian and Atlassian stock investors. So their strategy is to capture businesses through their investments in enterprise artificial intelligence and system of work. They went on to say that there's a record number of deals that they signed over $1 million to data center to cloud migrations, and that was up 60% year over year, and that they attribute to the strong momentum they had in Teamwork Collection. And this culminated in the RPO balance increasing to 3.3 billion. RPO stands for remaining performance obligations. Companies, when they sign a contract, let's say a 1-year contract for $1 million, or let's say $1.2 million to make it even on a monthly basis, they don't recognize, when they sign the contract, they don't recognize that as 1.2 million in revenue. They put that into the RPO balance and they recognize $100,000 in revenue every month they perform the service. And over the course of the year, it turns into 1.2 million in revenue. RPO balance increasing means that investors can be reasonably confident in the company's revenue they're going to generate in upcoming quarters. RPO balances growing faster than revenue is a very attractive situation I find with companies I'm following. Atlassian reported RPO growth of 38% in the most recently completed quarter, and that's much faster than the revenue growth rate they delivered in the most recent quarter and the revenue growth they're forecasting on a compounded annual basis over the next few years. The management team said that 74% of that will be recognized in the next 12 months, and that's up 29% year over year. By the way, this document I'm reading from is Atlassian's Q4 2025 earnings call transcript with Wall Street Analyst. I've made this highlighted document available to my channel members. If you want to follow along, go to my YouTube channel page, look under the membership benefits section. You'll see the link to the file, and in that file, you'll see dozens of these highlighted conference call transcripts. You can scroll to the Atlassian conference call transcript and follow along as you're watching these videos. So the company already boasts over 80% of the Fortune 500 businesses as customers today. But as a collection, they represent around 10% of their business. So even though they have a large percentage of Fortune 500 companies, it's still a small fraction of their overall business, and their overall business is more broadly diversified across a wider customer segment set. So one of their newer products is Rovo, and the management team saying that it's been exciting to see the reaction from customers and the increasing usage and adoption. It's always good to see when a company launches a new product and then reports back to investors and says that this product is working well. Customers are buying it and customers are liking it. A lot of times the opposite happens where a company launches a product and then comes back to investors and informs them and says, it didn't work out as we thought. We thought we were going to be able to get this much in business, but it turns out it's not working as well. But the good news is that we learned and we're going to use the learning from this process for our next product, etc. Right? So that could have been what happened. So it's nice to see when companies invest in a new product, the product is well received, and it generates sufficient revenue to justify the investment in creating the product. So just a reminder on valuation. Team, ticker symbol team for Atlassian is trading at a forward price to earnings of 41, which is a valuation that I see as attractive for a business with its characteristics. And so I've rated this stock as a buy because of comprehensive analysis, including the valuation. I've also done a proprietary DCF valuation where I calculated a fair value for this business at over $340 a share. And as I mentioned, at the current market price of 172, it's an attractive stock at current market prices. Hey everyone, so many of you have been asking about my investing strategy, and I'm excited to announce that I've written a book that's available for sale now that describes my 6-step investing framework for evaluating stocks. I've added the link in the description below.